you. How can we help you?
Yeah, very good morning, madam. Very good, all of you, sir. Yeah, actually, I have Reliance Industries 200 numbers at the rate of 1220 there. Can I add some more, madam? At least 300 to 400 shares for long-term investment for 1 to 2 years.
Okay, got your point, Govind. I'll quickly go to Asta on this one. Asta, RIL came with its earnings yesterday. What was your reading? And Govind wants to know whether he could add more of this counter to average out.
Yes, because the results that were above the expectation. So we were very much positive on that counter. And we expect that this counter has a potential to move till the level of 1435 to 1450. So these are the price targets which we are giving or recommending to our clients for this counter as of now. So definitely on dips, because right now also what we can see that this stock has already up by 2%. It's better to take or accumulate it on the dip at around the level of 1380 or 1370 odd levels. But yes, this stock has a potential to move till the level of 1435 to 1450 and in the longer term 1500 levels.
Okay, so that's the view with regards to where RIL is concerned. Our next question is from Rama Mohan, who is writing in and asking about Amara Raja. He's holding 64 odd shares, bought at 1203 a piece. And he's a long-term investor is what he's saying. So he wants an outlook on this particular counter. Asta, I'll have to come to you again. What's the outlook like for something like an Amara Raja?
So what we are seeing in this space, that is the battery space as a whole, there is a strong momentum which is going on right now. Now, if I talk about this counters especially, I think this counter is a good long-term story as they are the flagship company of the Amara Raja group. And we know that there is a strong demand in the lead acid business. And I think that will help the company in posting good numbers. So and this business, basically, if I remember correctly, it contributes 96% of their revenue. So I think there is a good demand in this segment, and this will help the company posting very good set of numbers. I'm very positive on this counter, and we are recommending a whole good long-term prospects are there. Right now it is quoting 995. We are expecting this counter to move till the level of 1150 to 1200.
With regards to where Amara Raja is concerned, our next caller, Vasu, is calling in from Tamil Nadu. Vasu, a very good morning to you. How can we help you?
Good morning, ma'am. See, I'm calling from Coimbatore. My name is Vasu. I'm holding Shriram Finance 1,000 shares at 641.33. What is the future?
Okay. Vasu, just help me understand one thing. Are you a long-term investor in this particular counter?
I can hold for 3 months.
You can hold for 3 months. So you want a technical view on this particular counter. All right. Kush, I'll come to you. Shriram Finance posted its earnings yesterday. In terms of how Q4 panned out, well, PAT was completely a miss on the back of higher credit costs. But this is where fundamentals are concerned. But with respect to where charts are concerned, how are you reading them? Do you think this is the right time to enter or keep holding?
So I think you should continue to hold with the stop loss around the 590 mark. Now, while, as you've pointed out that, the numbers weren't really to the expectation of the street, some of it was already showing in the price where, you could see two legs of a negative RSI divergence. So even as the stock was moving higher, the strength was actually starting to wane off. And hence, you are seeing some sharp profit taking in the last 3 to 4 sessions. Today, also the stock is lower, but it's trying to hold above yesterday low that it had made around the 595, 596 mark. Hence, with a bit of a cushion, 590, that should be a stop loss. The medium-term trend in the stock is actually quite favorable, quite bullish. So I would hold on. If 590 is taken out, then this trend could be negated and the stock could head lower. But with a 3-month time horizon, I think there is sufficient time for the street to absorb these results and perhaps move higher as well. So with 590 as your stop loss, continue to hold Shriram Finance.
Okay, continue to hold is the view coming in on Shriram Finance where technicals are concerned. Our next question is on Tejas Networks. Ekam Barai from Hyderabad is holding 150 odd shares of Tejas Networks at 1204 a piece and wants to know whether he should continue to hold or book a loss since the results were not very good. Asta, I'll come to you on this one. I had a cursory glance on this particular counter. In terms of the net loss, it did come down. It was a net loss of 71 crores versus a profit of 147 crores and the EBITDA was down around 61%. Not sure as to what went wrong with the counter if you had the chance to look at the earnings and of course the outlook for the counter.
Yes, we did look at the earnings, and there is one more point. In fact, in their quarterly results, also they have posted losses. If I exclude other income, extraordinary items, and for the full year also, it is a loss in the books. And now, what we believe, along with this loss, the company is quoting at a very high price to earning multiple. If I compare it to the industry average of around 29, they are quoting at a price to earning multiple of 27. So I think, along with the poor financial performance, the valuation seems to be stretched at this point of a time, and definitely that makes the case for the stock to fall more. So yes, Tejas Network is looking right now in the downward momentum. Maybe the stock can fall till the level of 700 to 680 odd levels. But if the view is purely long term, that is more than 8 months or a 12-month view, then a person can remain invested in this.
Okay, remain invested if you are holding this stock from a longer term perspective, is the view coming in from Astha on Tejas Networks. Our next caller, Shweta, is calling in from Andhra Pradesh. Shweta, a very good morning to you. How can we help you?
Hi, very good morning, Madam. My question is regarding Castrol India.
Okay.
I have 240 shares at 208 rupees.
Okay.
I would like to know if I can add more. And I want both, if possible, I want both fundamental and technical view about this stock. I would like to hold it for long term.
Okay, you would want to hold it for the long term. Then I'll go to Astha quickly. Astha, in terms of Castrol India, because they follow the calendar year, it was the Q1 results for them, where overall earnings, stable volume growth was there, and this was despite of the external pressures. Plus, there were new launches, and they've also expanded their distribution network. What's the view with regards to, of course, the Q1 earnings, and from a longer term perspective, should she continue to hold the counter?
One can continue to hold the counter, but please don't add more. Why? Because the results were not that exciting. If I look after Q4 numbers, it was merely a single digit growth, that is less than 5% growth in the bottom line. So the results were not that encouraging. And in fact, on the volume front also, we are not very much optimistic as of now. So yes, one can remain invested in this counter for the longer term, but please don't add more at the present level, because we feel that the counter is poised to move more down side from here.
Okay, so that's the way with regards to where Castrol is concerned. Our next question, Kush, this one's for you. Tata Motors is the counter. Amar has bought 50 pieces at an average price of 876 and wants to know as to when can he expect his break even, because he's been holding it and sitting on a loss of 10,000 rupees right now. What's the view like where charts are concerned for something like a Tata Motors?
Well, I'm afraid the outlook is not as rosy or as positive as he'd like it to be. I mean, the buy price is close to the 200-day moving average, which is some distance away. If at all, you can take heart from the fact that we've spoken a few times on the show, on the channel, that 600 is a historically strong support zone, and by that I mean historically, as in for the last 7-8 years, that's the kind of level that the stock has respected. Even this time around, if you give a concession of a couple of sessions, the stock actually respected that 600 level and is starting to rebound from here. Momentum seems to be picking up, but I think given the kind of massive downturn that the stock has taken, you will see selling pressures along the way. So it could be a while before he sees his price 2, maybe 3 quarters. On the way up, what I would suggest is that if you want to lighten your positions, then 695 is one level where you should start considering. 750 is another level to consider to go light on the position. You will obviously be incurring a loss, but it will be relatively lesser to what you're incurring currently. So with a positional stop around the 600 mark, keep exiting at these levels, as the stock moves higher.
Okay, so that's the view with regards to where charts are concerned for Tata Motors. Our next caller, Bala Murugan, is calling in from Chennai. A very good morning to you. I believe you have a query on Canara Bank.
Yes, madam. Good morning, madam. I want the technical perspective of Canara Bank, madam. I am holding 920 shares, madam.
Okay. I'll take this up with Kush then. Kush is holding 920 shares, bought at 102 a piece. The stock is currently trading at 100. What do you think? What are the charts indicating?
It's a very clear hold. For now, if you see the run up in the stock, in fact, in the entire PSU pack, it's been very encouraging. And if you were to ask me my top picks in the PSU pack, it will be SBI, then followed by Canara Bank. So fairly positive on this one. I think you should keep a stop loss around the 95 mark. The reason you're seeing some resistance at the moment is because markets have also seen some sort of profit booking. There is some cool off in the banking space after a month and a half of stellar run. And for specifically, about Canara Bank, the 200-day moving average is at 105. Plus, also you'll see some congestion of call writing, happening alongside. That's why the stock is just resisting around the 100 mark. I think once that is taken out, the stock could boom past his buying price to levels of 105, perhaps even 111. So continue holding on Canara Bank. The structure is fairly positive. Some consolidation that you're seeing right now is par for the course.
Okay, so that's the view with regards to where Canara Bank is concerned, and hold is the view coming in from Kush. Our next question is on defense counter, that is BEL. Giri Rao has bought 22,250 shares at 267 a piece and sitting on a significant profit of 10.9 lakh rupees and almost 11 lakh rupees right now, and wants to know whether he should hold or book profits and exit. He's a long-term investor, at least 5 years is what he's saying. Asta, I'll come to you on this one. Defense is on a roll since the past 2 days. I mean, it's over its 8 months high right now, the entire Nifty defense right now. But with regards to where BEL is concerned, should he continue to hold for the next 5 years? He's already sitting on a profit of handsome 11 lakh rupees.
Yes, I think now there are 4-5 points behind it. First of all, government trust on defense, especially manufacturing and electronic defense space. Secondly, the robust order book the company is having. Thirdly, their share in the defense, especially if I talk about the electronic share in the defense, that is also very high. And I think the fourth point is about the leadership position which this company is enjoying in this space. Their order intake is around, I suppose, 10,000 crore. So I think all this is cumulative order intake, which I'm talking about till February or March. So all these things are pointing towards a strong future of this counter and the strong revenue visibility as well, as because that is also very, very important. So yes, one can remain invested in this counter. However, would like to give the immediate targets, which can be at around 350 to 370 odd levels. But in the longer term horizon of 5 years, the stock can be a multi-bagger from the present levels.
Okay, so that's the view with regards to where BEL is concerned. Our next caller, Alex, is calling in from Kerala. Alex, a very good morning to you. How can we help you?
Good morning, ma'am. I have a query on RailTel.
Okay.
I am holding 140 shares at the price of 363.
Okay.
I need a fundamental view on this. Actually, I taken it as a railway stock, but when I looking at the stock, it is into this data center business also. Is it okay to hold for data center business, or I need to add another stock for that data center business like Anant Raj?
Got it. Asta, I'll come to you on this one. RailTel is the counter. What he's asking is that should he stay invested in this particular counter, and he also wants an exposure to data centers. So what do you think? He should continue to hold this counter or add more for something like an Anant Raj?
So I think this counter one can hold at least till the results, and when are results expected? I think 1st of May. So they are scheduled to come on 1st of May. So there is no harm in holding this stock at least till that time. Now the other positives about this counter is the continuous receipt of order which this company is getting, and in fact whatever results they have shown in the Q3 also, they were also very decent. So all in all, I think the RailTel is the counter which one can remain invested in rather than going with the Anant Raj at least till the results come, and then again he can ask his query in the show after 1st May.
Okay. Srinidhi from Udupi, Karnataka is also writing in, and she's bought Anant Raj at 528 a piece, and she wants to know whether she should stay invested in this particular counter or not. Kush, I'll come to you. The stock is doing well in trade today, up by about 2.5%, but the overall trajectory for this particular counter has been pretty topsy-turvy. Your view with respect to where charts are concerned for Anant Raj?
I think after the kind of massive fall from those 925 levels, the stock is now trying to find its feet. If you see the last 2-3 months, it's held on to 425 for the most part. So I think that's a positional stop that you should have on Anant Raj. Sideways consolidation for some time cannot be ruled out, especially because on the way up, the volumes haven't really been as encouraging. In fact, on some of the down days, the volumes have picked up. So I think there could be some consolidation. I don't see a runaway rally coming on Anant Raj, anytime soon. So keep a positional stop loss near the 425 mark. If that's breached, then you're better off exiting this one. On the way up, resistance is around the 550, and then the 650, 645 zones will act up. But as I said, there's a possibility that for a quarter or two at least, the stock could just move sideways within these within these levels, within these bands that I just mentioned.
Okay, so that's the view with regards to where Anant Raj is concerned. Our next caller, Murli, is calling in from Bengaluru. Murli, a very good morning to you. How can we help you?
Very good morning, madam. Thank you very much for taking my query.
Our
I
pleasure,
bought
Murli.
Dodla Dairy.
Yeah.
The recent fall about 8-10%.
Okay.
At 1,098, I bought 200 shares
Okay.
the last week.
Okay.
So I want to add more. What is your view, considering that it is one of the lowest if we compare to other consumable
Okay.
and similar industries,
Okay.
compared to Arts and Agro or Heritage Food
Okay.
or Dr. Baker, Dr.
Mr. Becker's, yes, yes. Mrs. Becker's, not even Mr. Okay, I'll take this up with Astha. Astha, so what he's trying to say is that he's already holding 200 odd shares of Dodla Dairy and wants to understand whether this is the right pick from the entire dairy space. There's Hatsun Agro as well as Heritage Foods that are peers of this particular counter. Do you think that he should stick to this one or shift to something like Hatsun Agro or Heritage Foods? And he's also mentioned Mrs. Becker's.
I think this is also a good bet buy because they have earmarked 28 crores of capex. In fact, their 9 months results were exceptionally well. They are now expanding their footprints in the Maharashtra. So I think looking after all these numbers, and in fact, they have got a very good demand. Healthy festive demand has led to the strong set of numbers which they have posted in the quarter gone by. So looking after all these factors, I think it's better to stay invested in this counter. So let this counter be continue in your portfolio, maybe for another 10 to 15% upside from here.
Okay, hold is the view coming in on Dodla Dairy where fundamentals are concerned. With that, it's time to slip into a very short break, but we'll be right back answering more queries on the other side, so stay tuned.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
Welcome back. You're watching Ask Profit, a show that gets all your stock-related queries answered, whether they're fundamental or technicals. For viewers who are just tuning in, you can either call us or WhatsApp us on the numbers that are flashing on your screen right now. All right, our next question is from A. Raja. He wants to know whether this is the right time to buy KFin Tech from a longer-term perspective or not. Asa, I'll come to you on this one. What's the view like for something like a KFin Tech?
We are very much positive on this counter. Yes, one can really make an entry into this counter, although our price targets are at the initial level because it is quoting at around 1281. So it is somewhere at around 1350 to 1400 odd levels. But yes, one can make a entry into this counter. Now, the reason behind it, first of all, what we have seen in the results gone by, that the revenue were broadly in line with the industry. And now there are structural tailwinds which are there in the mutual fund industry, and that will help in their absolute revenue growth. This is what we believe. And they have also a unique platform as a service business model. So I think that will also help this company in having a very, very strong financial or a future visibility. So yes, one can make a fresh entry also in this counter. Initial price target can be 1350.
Okay, so that's the view with regards to where KFin Tech is concerned. Our next question is from Suresh, who's calling in from Hyderabad. Suresh, a very good morning to you. How can we help you?
Yeah, hi, very good morning. Thanks for taking this query. Is it right time to take entry on Redington as it is trading at its all-time high range? So for short term.
I'll take this up with Kush. Kush, quickly on the charts, Redington, how is it faring? Is this the right time to make an entry?
Well, not a bad move, I would say, from the recent levels. It's just that on the very smaller time frames, the stock is now starting to show some mild negative divergences. Also, coming up to the resistances of the 250 to 55 mark. So I think on declines, adding Redington would be a good idea. The medium-term trend is intact, and it's moving up after a bit of profit booking. So closer to the 235 to 40 zone is where you should perhaps consider an entry into it. Some profit booking could come about in the next few days. An entry closer to the 240 mark, and then your targets will be 255 and about 270 odd. On the way down, keep a stop loss near the 225 mark.
Okay, so that's the view with regards to where charts are concerned for something like a Redington. The stock is down by about 0.2% as we speak. All right, the next question is from Satyan. He wants to have a view on Awfis Solutions. He's holding it since the past 8 months. Bought at 668 a piece and wants a long-term view on this particular counter. Astha, what's the view like?
Long-term view is here positive for this counter, and we believe that this counter can move till the level of 800. Although our price targets are a little higher than that, but at the initial levels, we would like to give 800. What a move! What exceptional move it has given after the listing at around 383. And first of all, the main reason about the positivity in this counter is that they are continuously delivering and on what they are guiding. So that is also very important for any company, because they were guiding of around 30% plus revenue growth in FY25. And in fact, they were also guiding about the margin expansion. And they are delivering. So I think if management walk the talk, then definitely that leads to a very, very strong confidence in the counter. We are positive on this counter, remain invested in this counter with a price target of 800.
Okay, so that's the view with regards to where Awfis is concerned. Our next question is from Shiva, who wants a view on TVS Motors. He wants to know whether he can buy at the current levels. In terms of the numbers, they looked pretty decent, Astha, but the street is not taking it very well. The stock is down by about 3.4%. In fact, even brokerages have maintained their buy. Some have even hiked the target price. What's it that the street is not liking, one thing, and what's the outlook like? Should one continue to hold this particular counter?
Street is not liking the valuation. Valuation wise now it is highly stretched. Because what we have seen, in fact, the stock has already risen a lot before the results and the valuations becomes very stretched. And one more thing, one IPO is coming. So, when we were looking after that IPO also, so what we believe TVS Motor hold one distinct feature, and what is that continuously they are moving towards innovation. They are continuously adding certain features, especially in their TVS Jupiter, if this bike I talk about, and that holds the major attraction for all the customers. And this is what the ground check we have done, and afterwards we arrived this point that their product features are so good, then definitely it leads to a strong sales to them. And we have seen that in the past few years, and on that basis strong growth in the financials and strong valuations also which they are commanding. So right now it is just the valuation matter. That is why the stock is falling, but I think at certain level it will settle down and again move northwards. So yes, our idea here is to stay invested in this counter. Maybe some lower levels can be seen. So if anyone want to make a fresh entry, then fresh entry is also recommended, but not at the current level, maybe at the 2600 or 2580 odd levels.
Okay, so valuations is something that the street is not liking, is the view on TVS Motors. Our next caller, Hari, is calling in from Chennai. Hari, a very good morning to you. I believe you have a question on United Spirits.
Hi, this is Hari here. My question is regarding United Spirits. I currently don't hold anything in this sector itself. So, I just like to know, whether it's a good pick in this space.
Hari, you would want to hold this from a longer term perspective?
Actually, I just want to hold it for 2 to 3 years of horizon.
2 to 3 years. Okay. I'll take this up with Astha then. Astha, from the entire Alcobev space, United Spirits, is this the right counter to buy, or are you looking at something else?
No, this is also one of the good counter. Why? Because the volume-led growth was very high. It was a double-digit volume-led growth, which they have shown in their financials. So this is what we believe is one of the key factor. And secondly, the gross margin expansion is also very good, and it is continuously expanded, because I believe in the last quarter also it was like around 100 or 130 basis point of gross margin expansion at around 44%. So what a strong expansion this company is showing. So volume-led growth is there, margin expansion is happening. So I think it makes a case to remain invested in this counter. So hold is a strategy from our side for this counter with a price target of somewhere at around 1650.
Okay, hold is the view on United Spirits. Next question is from Neha, who's writing in from Bengaluru. She's making 17% profits already in SBI Cards. Wants to know as to what should be the target for the next 1 to 3 months for this particular counter. Kush, what are the charts indicating?
Well, a strong medium-term uptrend on this one. Although this is not this is not a one-way street. The stocks had its moments of consolidation and sharp bouts of profit booking, but that's actually a healthy sign. You don't want it to run up one way. Suggestion would be to hold a positional stop near the 825 mark. On the way up, you could see the stock actually reclaiming the recent swing high that it made close to the 920 mark. Once that is taken out, 965 or thereabouts is also on the cards. So my suggestion would be to continue to hold on to this one. And what you could do is, as the stock moves higher, keep trailing your stop losses because the stock's fairly volatile. If you see a kind of a big break, then these might erode your profit. So 825 to begin with as the stop loss, but as I said, keep moving higher. Keep trailing your stop losses higher as the stock rises up.
Okay, our next caller, Paramjeet, is calling in from Himachal Pradesh. Paramjeet, a very good morning to you. How can we help you?
Good morning, ma'am. I am having 100 shares of Force Motor.
Okay.
At the rate of 9,000.
Okay.
I want to know long term as well as short term view.
Okay, I'll take this up with Astha then, Paramjeet. Astha, Force Motors came out with its earnings today. Prima facie, the number looked pretty good, and in fact, there was growth as well. What is your reading, and should he continue to hold the counter?
Yes, they have come out with the numbers. Prima facie looks seems to be good. And in fact, I mean, the bottom line growth, especially if I talk about the year, full year of FY25, is good. In fact, the valuations at which they are quoting is at around 14 to 15 price to earning multiple, as against the industry price to earning multiple of 33. So I think things fall in place for this counter. Remain invested in this counter. Initial price target can be set at around because 9,000 it is quoting, so 10,500 or 11,000 levels can be seen.
Okay, our next question is from Bimal, who's writing in from Mumbai. He's holding 1,000 shares of L&T Finance at 140 a piece. Wants to know if he can add more at the current levels, and he wants to hold it for the next 6 months. Coach, I'll come to you on this one. L&T Finance, how are the charts faring?
Fairly decent, I would say not one of the top bets in the NBFC space that you often go out and pick. But kudos to him for buying it at a good price and to hold on at the current juncture. Now to the question that can he add further? The answer is yes. The stocks had a pretty sharp run up all the way up until 180, but in the last couple of sessions the cooling off has also happened and is now close to the 163, 165 support zone. So I think not a bad idea to buy on dips. The medium term momentum will resume in some time for a lot of these financial names after the kind of sharp run that we've seen, including L&T Finance. So yes, he can consider adding on. As far as the stop loss goes, a positional stop near the 150, 155 mark. On the way up, he could well see the recent high of 182 being hit. Once that is taken out, 195 is also in play. So continue to hold, and in fact, on this decline closer to the support level, you could consider adding some more.
Continue to hold for L&T Finance with respect to where technicals are concerned. And next question, Vishal is calling in from Chandigarh. Vishal, a very good morning to you. How can we help you?
Very good morning to you, ma'am, and thank you for taking my query.
Our pleasure, Vishal.
Yes, ma'am. I'm holding about 776 shares of Kitex Garments at a price of 185. Okay, I see a merger coming in between Kitex Garment and Kitex Children Wear, and Kitex Garment is also into a lot into capex. So I'm just inquiring whether I should average up and hold it for about a period of 3 to 5 years. I just want to know basically whether it's a good long-term pick.
Okay, got your query, Vishal. I'll take this up with Astha. Astha, I'm not sure if you're aware about the entire merger part that Vishal is talking about, but even in terms of the entire tariff saga, although it's at a 90-day pause right now, and India is in fact in talks with the Donald Trump government to make sure that the tariffs come at the lowest levels, but Kitex is one of the counters that might get impacted because it exports to the US. What's your view with regards to where this particular counter is concerned? Should he continue to hold for the next 3 years?
Yes, so the merger is with the Kitex Garments and the Kitex Children Wear, if I'm right. And I think that they have got approval in the February, only 14th February, I suppose the date was that. So now this is, this is the company which is the world's second largest infant manufacturing facility. And now, with the kind of boost they are getting, I mean, we are expecting, in fact, the company has released its presentation few days back in which they have projected a very strong turnover. I think it is more than 1,000 crore, if I'm not wrong with my numbers. Pardon me if the numbers are something else, but I suppose the numbers were that only. So I think this company has got a real potential and it is a very good bet in this space, textile space. So yes, one can remain invested in this counter. Initial price target, which can be attributed to this counter, is at around 285 to 290 odd.
Okay, so hold is the view coming on Kitex Garments. Our next caller, Niket from Bengaluru, is asking his view on Tejas Networks. Niket, we've already taken up a fundamental view from Astha on this particular counter in the first half of the session, but I'll also take up technical view from Kush. Kush, Tejas Networks, how are the charts faring, and do you think that this is a good counter to keep holding?
But from a long-term perspective, perhaps, as Asa already mentioned, but I think from a near-term perspective, I would wait because, the stock was attempting a recovery. from those 650 levels. But as you said, maybe because of the result, it's taken a sharp knock. At the moment, trying to find its feet, volumes way higher on the way down. So you might want to just wait up. I think an intermediate support comes close to the 725 mark, but a positional support is near the 650 mark. So you want to see whether the stock, in fact, respects this band or not. If it does, then you could see the upward rally resume, in some time. But for now, I would just hold up on the purchase and let the dust settle on this one.
Okay, that's the view with regards to where charts are concerned for Tejas Networks. Our next question is from Anup, who's writing in from Goa. He wants to know the target and the stop loss for Axis Bank from a shorter term perspective. He's not mentioned the time frame per se, Kush, but with regards to Axis Bank, let's say a stop loss and a target for the next 3 months.
So I think a positional stop for this one is at 1145. You've seen the accumulation happen around those levels in the past. In that stock, has acted as a bit of a resistance. Now will act as a support. So 1145 is your stop loss on Axis Bank. On the way up, I think you could look at the first target close to about the 1265 mark. I beg your pardon. And once that is taken out, 1320 is also in play. A closing above this 1210 zone will actually complete a rounding bottom formation on the weekly basis, and then you can see the momentum coming back into the stock. As I've mentioned a couple of times already on the show, that a lot of financial names had seen run up, some cooling off along the way, but I think the trend is intact. So for 1265, 1320 kind of levels, you should continue holding on to Axis Bank.
Okay, so that's the view with regards to where charts are concerned for Axis Bank. Our next question is from Avdesh, who's calling in from Varanasi. Avdesh, a very good morning to you. I believe you have a question on Mahindra EPC.
Yes, ma'am. Good morning.
Good morning, Avdesh. Go ahead with your query.
Ma'am, I have Mahindra EPC Irrigation Limited at the price of 130, 50 shares.
Okay.
And I want view for the long term, ma'am.
Okay.
Can I add more?
Okay. Got your query, Avdesh. I'm not sure, Astha, if you have a view on this particular counter. It's a very small company with 395 crore of market cap. If at all you have a view, or I'll go to Kush for the charts.
Sorry, I have not tracked this company as of now. Can't express my views on it.
Fair enough. It's a very small company. Kush, on the charts?
So not too encouraging. I mean, the stock's been fairly volatile and practically directionless for the last about year or so. It's not really given any kind of returns. No major upswings or volume breakouts that we are seeing that could suggest that maybe indeed the stock is now out of the woods and could head higher. So I would avoid Mahindra EPC for now.
Okay, avoid is the view coming on where charts are concerned for Mahindra EPC. Our next question is on Mazagon Docks. Bharati wants to know whether she should continue to hold or sell this particular counter. Astha, what's the view like?
Definitely a hold. The kind of momentum we are seeing in the defense space, there is no logic to exit from this counter. So we are positive on this counter. In fact, when the OFS came, then also we have recommended our clients to apply for it on the longer term. So yes, for the longer term, we are optimistic on this counter, remain invested with a price target of around 32.
Okay, so that's the view with regards to where Mazagon Dock is concerned. Our next question is from Sonal, who's calling in from Chandigarh. Sonal, a very good morning to you. How can we help you? Hi Sonal, can you hear me? Okay. Yeah, I can hear you, Sonal.
I'm having 600 shares of eMudhra at the rate of 800.
Okay.
I want to know long term as well as short term.
Okay, I'll take this up with Astha. Astha, any view on this one? eMudhra is the counter.
Yes, I know. So long term seems to be positive, but I think everything depends on the upcoming numbers, which company will be set to announce on 6th of May. So what we believe that just wait for this counter till the results come. Meanwhile, if I talk about their past performance, that is the Q3 FY25 performance, it was good. Why? Because the income has shown the rise of around 40%, strong rise, we should say, EBITDA at around 19%. So good growth they have posted in the quarter gone by. But we have to really wait for the results and then again can review the query. Meanwhile, stay invested in this counter. Results can come on 6th of May as far as I remember.
Okay, wait and watch as to how earnings fare for this particular counter. Till then, hold is the view from Astha. All right, our next question is from Neelam, who's writing in from Jaipur. He's making 18% profits in Manappuram Finance and what's the target for the next 3 months? Kush, on the charts for Manappuram Finance, what are the targets and stop loss for the next 3 months?
I think you should place a stop loss near the 220 zone. That's the recent swing low that the stock has made. Also, you've seen some buying come in at around those levels. And on the way up, don't be surprised to see the stock cross the 250 mark, in the coming days. And once that is taken out, you're looking at a 265 to 70 zone also being tested. All in all, I think the stock is in a good space. There's a sideways consolidation, that too with a positive bias going on in the stock on a weekly setup. Also, the stock's looking encouraging with the volumes picking up. So all in all, as I said, it's got a few things going for it. Hold for a second target of 265.
Okay. As a quick one on Gujarat Pipavav, Harjeet from Mohali is holding 1400 odd shares, bought at 138 a piece. Oh, okay, no, he's not given his target price. Okay, it's 400 and the stock is currently trading at 137. So he's sitting on a loss of 3.67 odd rupees. What's the view like?
Yes, right now it is yielding losses, but I think remain invested is a better option as of now because I think going ahead, this counter can show some good numbers, which we believe, and hence we are positive on this counter. Remain invested in this counter.
Okay, so that's a view with regards to where Gujarat Pipavav is concerned. With that, Kush and Astha, thank you so much for taking our time and giving us all those insights on all the stocks and queries. All right, let's shift focus to Adani Green Energy. It reported its Q4 earnings with net profit rising 24% and revenue expands over 22%. Sagar Adani, Executive Director at Adani Green Energy, decodes their Q4 performance. Listen in.
I'm thrilled to share the outstanding operational and financial performance of Adani Green Energy for the fiscal year 2025. FY25 has been a record year for India's renewable energy growth with a remarkable addition of 30 gigawatts across the country. At Adani Green Energy, we contributed significantly by adding 3.3 gigawatts of new capacity. This is the highest ever by any renewable energy company in India. Our efforts accounted for 16% of India's utility-scale solar and 14% of wind power installations in FY25, showing our commitment to driving India's clean energy transition. We are making significant progress towards developing the world's largest renewable energy plant at Khavda in Gujarat. We have operationalized 4.1 gigawatts within just 2 years of commencing work. Now, we are on track to complete the 30 gigawatt project by 2029. We attained a high solar CUF of 32.4% in Q4 FY25 at Khavda. The impressive figure underscores the site's high resource potential and impact of deploying advanced technologies such as bifacial N-type modules, horizontal single-axis trackers, and waterless robotic cleaning systems. Our relentless focus on execution, operational excellence, and advanced technology has yielded outstanding results, further cementing our leadership in the renewable energy sector. In FY25, we surpassed $1 billion in EBITDA, a testament of our robust business model and sustainable growth. Our energy sales increased by 28% year-on-year, reaching 28 billion units. Revenue from the power supply grew by 23% to rupees 9,495 crore. EBITDA increased by 22% to rupees 8,818 crores. We continue to prioritize digitalization, robust capital management, and best-in-class governance. Our digital initiatives encompass advanced analytics, automation, and AI-driven decision-making processes to optimize project development, operations, safety, and governance. As an important milestone in our capital management journey, Adani Green refinanced its maiden construction facility, which was instrumental in the development of the world's largest solar wind hybrid renewable cluster in Rajasthan, which was delivered in FY23. This long-term refinancing, rated AA+, represents door-to-door tenure of 19 years with fully amortized debt structure. It is well aligned with the cash flow life cycle of the underlying asset portfolio. We in fact have a very comprehensive capital management framework to fully fund our growth up to 50 gigawatts by 2030, while still maintaining a very strict credit discipline. We are committed to our environmental, social, and governance goals. In pursuit of building green energy in the greenest way possible, we are glad to share that all our operations are now water positive. We have achieved this goal 1 year ahead of our original target. We continue to maintain top rankings from esteemed global ESG rating agencies, including being ranked number 1 in Asia and among the top 5 globally in the renewable energy sector by ISS ESG. Sustainalytics also ranks us amongst the top 10. We attribute our success to the dedication of our team and the steadfast trust and support of our shareholders and partners. Together, we are committed to creating lasting value for all of our shareholders and delivering 50 gigawatts of clean and affordable power by 2030. Thank you.
That's huge. That is a biggie. It's on.
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have 2 credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
Apollo Tyres, now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm.
Hello and welcome. You're watching KYC. Now, a lot of the companies that we've been speaking to and speaking about are inward looking, and therefore, to some extent, if at all, that's still part of the equation in terms of investment. It's also tariff insulated in that sense. So let's look at PNB Housing today actually. So interesting because we've seen a turnaround in the business of sorts, very strong numbers that we've seen, 2.5% plus on the ROA number. Can that sustain is the first big question that we'll ask. The second one is, what's the expected credit cost as it normalizes? This is the provisioning number which hits your profit and loss account. So what that number is going to be as it normalizes. They're going into slightly new businesses as well, newer geographies as well. Does that at all impact your credit cost in terms of expectations? The third piece is with regard to risk within the affordable housing finance segment, and this is something of an additional point to what we just covered with regard to credit cost. As it normalizes, what's that kind of number that we look for? What's the possible risk to growth? Because growth has been tough in terms of visibility, at least over the last 3, 4, 5 years. Can that change going forward? That seems to be the guidance. What will be the levers and what gives the comfort that growth is back for good? Now, in terms of the fifth point, asset quality has improved substantially. Can this kind of number start to sustain? Is this the realistic number that we look for? And last off, most importantly, from an investor perspective, are valuations at this point looking fair? That's really the question we'll try to delve upon. And in order to start and try and break this down, as always we do, let's look at the metrics that we'll look at when you're looking at a PNB Housing. Before we look at metrics, let's look at the company itself. First, what do you look at? It's the third largest housing financier in the country. It has around a 98.5% within its entire loan book base. It's got around 98.5% of retail loans. So predominantly is doing retail at this point. It's in that process of going into retail, and rather has now almost completed that process. Within retail, individuals is roughly 72% and non-housing loans are around 28%. Okay. When we're looking at a further split within the individual mix, look at self-employed, which is 39%, 61% is salaried. So that's a fairly healthy mix on both sides. You may want to have a little bit of more salaried in that segment. In terms of the lending split, around 75,000 odd crore in terms of the loan book value. Prime loans, prime markets are around 55,500 crore. Emerging markets are around 14,125 crore in terms of book size. So around 20% is emerging markets, and roughly 8 odd % is affordable housing. And this book is growing extremely fast. It's grown from 1,000 crore to 5,000 crore in the matter of a year. So watch out for that one. How will that impact margins will be one of the questions that I'd be curious to understand. 356 branches. They had 300 branches at the end of FY24, currently at 356. This is how the branches stack up and the AUM stacks up. Maharashtra is the predominant force in terms of loan share, 22%. Tamil Nadu at around 11.5, Delhi at around 11.1, Telangana at around 9.1, and then so predominantly the top 5 states, and I'll read them out. Tamil Nadu, Maharashtra, Delhi, Telangana, Karnataka account for 60% of the loan share for a PNB housing. Something again to keep in mind. How do they sell? How do they go distribute? In-house distribution is around 53% and direct selling agents is around 47%. That's how the distribution mix is playing out. Let's look at the borrowing mix, and this is where it becomes important because it will start to impact your cost of funds. So something to look out for. National Housing Bank roughly 13%, term loans is 38%, ECB is around 6%, deposits is around 28%, also the largest deposit taking housing financier in the country. NCDs is around 10 odd percent, and then you have certificates which account for roughly 5% odd. So that's how it kind of stacks up in terms of borrowing mix. Let's look at the metrics we'll track today. You have income statement, you have balance sheet, you have operational metrics as we do with all lenders, and we look at asset quality as well on this one. We'll also look at shareholding pattern, valuations, street cred and street coverage. We look at all of those and try and break it down, and thereafter speak with the management and try and get a perspective as to what can be expected on some of the apprehensions that are there with regard to a PNB housing as well. What are the risks like? But let's start off with an income statement. You know, the net interest income growth has been roughly 16 odd percent on a year-on-year basis, CAGR 3-year. That's how the NII growth has been. It's not been very impressive for that top line number. You'd want a better number, but the last 3-year CAGR looks okay. The last 2 years is just 20% absolute. So just about maybe just about single digit in terms of compounded annual return. So something to look out for. But what's really driving the numbers with regard to PNB housing and the profitability number is the provisions number. Provisions have come off sharply. The book has improved quite sharply. Now we're starting to see recovery start to play through. So they are playing an active role with regard to ensuring that recoveries which they have provided for earlier, all the recoveries have started translating on the PNL and are impacting the PNL also. Let's pull up the profit after tax number, and there's a negative 158 crore of provisions. So that's a write back of around 158 crore. The profit after tax is sitting at around 1,936 crore. So not only is it inflated with regard to the 158 crore, which is the net of the provisions made this year versus the recoveries. The recoveries are roughly 360 odd crore for the current financial year. So not only is it that, but the profits have seen a bit of a boost in FY25 on the back of those couple of factors. So profit after tax has gone up 32% over the last 3-year CAGR, but that's also because of this recovery number, something to be kept in mind. So a thumbs up with regard to this, because you have decent growth on the top line, provisions which are credit costs which are not translating to the PNL, which is a positive, and then you have profitability which is seeing a surge. May not be fair to look at this profitability standalone, but nonetheless you are expecting FY26 also to continue to see recoveries, and therefore you might see this profit as something which is more normalized in any case. FY27 will be where the real test starts to play out, where the income statement profitability is concerned. So we'll give this a thumbs up for now. On the back of that, let's look at the quarterly numbers as well. Q1, Q2, Q3. The NII number has gone up in a phased manner, fairly decent between Q2 and Q4. Provisions have largely seen write-backs in Q1, in Q2, Q3 and Q4, and profit after tax has been quite steady in that sense, with Q4 being the real outperformer, which is why the stock also buzzing in trade. Now let's look at the balance sheet, and this is where it starts to look slightly difficult. Let's look at FY23, FY24, FY25. No significantly sharp growth that we are seeing on a book size which is decent. You know, we have a Bajaj Housing as a comparable which is growing at a far faster clip. We have some of the smaller ones which are maybe a third of the size of a PNB Housing. which are also growing at a faster clip, but PNB Housing in terms of growth has dragged. Can that change? That's what the management seems to be suggesting, but we'll have to wait and watch whether that does. So the AUM growth currently, 3-year CAGR, is just 7% at this point over the last 3 years. So what's happened to capital adequacy as a result? It's gotten better because profitability metrics have gotten better while growth hasn't happened. So you're seeing a decent amount of capital build up within the company, but growth is where the concern seems to be. Let's look at operational metrics now. Let's look at the margin number. It's largely been steady over the last 3 years, which is a key positive, but it's maybe a minor negative from a perspective that your rates have gone up. You would want at some point, as the rates come down, for your margins to likely get better. Can they do that? Is there scope for that? Will be the question. Your ROA number has consistently gone up from 1.6 to 2.6%, led to a certain extent by recoveries that are playing out, but also by better operational performance. For sure, that is evident. Look at cost of borrowing. From 7.5% in FY23, your cost of borrowing is currently at 7.9%. So your cost of borrowing has gone up, but has come off from the FY24 levels. Can it continue to come off, and by how much will be the question. Spreads largely have come off, also likely because there's a lower risk build up there. OPEX to assets has gone up as they push retail and push towards branch expansion. Some of these metrics versus some of their competitors look okay, all below what one would expect in terms of at least OPEX to assets, well in range, and therefore we've given these operational metrics a bit of a thumbs up. We've seen an upward bias to margins in FY25. We've seen an upward bias to ROA as well. Cost of borrowing has been largely steady, and spreads too have been largely steady. So positive when you're looking at FY25, which is the short term. Positive when we're looking at the long term. A clear thumbs up with regard to this. Let's look at asset quality. Now this is where it starts to get fascinating. Your gross NPA ratios have come off from 3.8% to 1.08% in FY25. That's truly impressive. When I'm looking at the sequential numbers as well, Q2 1.5%, Q3 1.19%, Q4 1.1%. That's the gross NPA number. The net NPA number also looking equally good. 0.8% in Q3, 0.69% in Q4. So an improving trend on some of those metrics. Something to look out for always when asset quality is concerned. As it improves, you would start to see more confidence come in for the bank to grow as well, or a financial institution to grow as well. Whether this is the normalized level that one should expect in terms of a number is something that we really need to keep our eye out on, or whether, given that they are going into new spaces, whether we're looking at some amount of adversity which could start to creep through as well, and therefore where would the NPA numbers be is something that we'll have to look out for as well. Now in terms of, let's look at the shareholding, and this is where it also gets a bit interesting. You have the promoter holding at around 28 odd %. You have General Atlantic, which owns a stake in the company, mind you. You have promoters which currently own 28%, and within that promoter holding, I'm just going to try and spell it out. You have Punjab National Bank, which is the promoter entity which holds PNB Housing. But outside of that, within the FI holding, you have General Atlantic, which holds roughly 7.5%. That's Government of Singapore, my apologies. General Atlantic holds roughly 5 odd % of the company. So again, there's a decent amount of FI interest in this one. Something to look out for again. There's a decent amount of DII interest as well. You have lots of mutual funds which own a stake here. There's an Aditya Birla Sun Life, HSBC small cap. You have Nippon, you have HDFC, you have Axis. All of these hold decent chunks within the company, and therefore it's got a decentish participation. But the promoter holding is 28%. They borrow largely on the back of PNB being the key promoter here, and that's why their borrowing cost is low. in comparison to some of the other housing financiers. Again, that's something to look out for, because this promoter ownership of 28% likely to stay steady, but any change there could well impact the numbers for PNB Housing. That's how it's playing out. Currently, the public holds around 20.5% stake in PNB Housing. So that's shareholding done. We'll give that a neutral, given the risk. Let's look at valuations now. Let's keep three things in mind. One, your asset quality has improved sharply. That's a positive when you're looking at valuations versus some of the others. Point number two, you're looking at growth which has not been coming through, at least over the last 3 years. So on that count, the slower growth merits a lower valuation, and that's what it is, the 1 year forward PE. And three, you want to see a smaller book grow at a faster clip, but with new businesses coming in, there could be increased risk. So those three factors to be looked out for when you're looking at valuation. 1.5 times price to earnings, certainly 1 year forward, looks cheaper than some of the other counterparts within the housing finance space, but those are smaller than a PNB Housing. PNB Housing has a larger base as well. And you also want to look out for how the last 5 year average price to book multiple is, which is at 1.2 times. So in that sense, it's a slight bit of a premium. Again, we'll give this a neutral, because there is a turnaround coming, and we have seen leadership talk widely about that turnaround, and we've also seen analysts cover that turnaround a bit. So maybe a few of those aspects need to get balanced. Let's look at street cred. Well, it's performed very well over the course of the last 3 months or so. 30% returns. Last 1 month has been 24%. Last 6 months has been 18%, and last 1 year has been 35%. Truly impressive, given the fact that markets haven't done as well in the meantime, especially broader markets. Let's look at street coverage. They have 12 buy ratings, no hold, no sell, and a 14.5% upside on the stock. So a positive with regard to that as well. Let's try and stack it all up and try and give this one our KYC rating, and that's how it stacks up. A balance sheet is a neutral because you want better growth there. Let's look at the next graphic, and within that we look at how shareholding, street cred, street coverage and valuations look, and that's how it stacks up. On our KYC ratings, it gets a 6.5 on 8. Very impressive, at least in that sense, but lots of monitorables, and therefore we bring in Girish Kausgi, who is the Managing Director and CEO at PNB Housing Finance, to speak to us about, of course, Q4 numbers, sir, but more importantly, what the journey of PNB Housing is going to look like in the next 2 to 3 years. Good morning, Girish. It's always good chatting with you. I want to first start off by asking you exactly that. Growth has been muted over the last 3 years. You have guided for a late teens kind of growth for PNB Housing over the next 1, 2, 3 years. Two questions, therefore. How confident are you, and how does the mix change as a result? Because affordable housing is taking a larger share of the pie when it comes to incremental disbursements.
Good morning, Harsh. I think thanks for the detailed and comprehensive analysis of PNB Housing. I think very impressive. I think let me first address growth.
Yeah.
If you look at PNB Housing, growth on book or disbursements 3 years back, it was flat. It was negative. Now, 2 years back, the growth started off with 10% on book. I'm talking about retail book, because corporate we had stopped business because of stress. So it was 10%. FY24, the retail growth was 14.1%, and FY25, the retail growth is 18.2%. We had guided a retail growth of 17%. Against 17, we are at 18.2. So from 10 to 14.1 to 18.2, very clearly there is growth. And if you look at the entire mortgage industry is growing at about 13 to 13.5%. We were below industry average. Now we are far higher than industry average. And this is number one. So very clearly there is growth because we are at 18.2, and not many companies, given the mix of prime, emerging and affordable. Even if you have to look at growth within affordable, FY25, our affordable growth is 180%. We took the book from 1790 crores to over 5,000 crores in 1 year. The entire affordable story in 27 months, we have built a book of 5,000 crores. Now the book is 5,070. Look at emerging. We started emerging in FY25 because of better profitability, better margin. That has done well. Now the book of emerging is about 14,000 and odd. So overall book now retail is about 74,800 crores. The plan is to take it to 1 lakh. So very clearly you will see that the growth is there, which is in higher teens, which is 18%. And come a year or two, the growth could be in excess of 20%.
Okay. So how would the mix evolve therefore over the next maybe 2 to 3 years? How balanced would it be in terms of prime, affordable, as well as your mid-tier?
So because of profitability reasons, we started affordable. Today, affordable and emerging, the disbursement mix together is 40%. And we had guided 40% by March. We started off beginning of the year FY25 with 32% mix. We ended up with 40% mix. Today on the portfolio, emerging and affordable, which means higher yield business, is 23%. Come FY27, so March 27, the overall book is going to be 1 lakh crore retail book. Out of 1 lakh crore, affordable is going to be 15,000 crores. March 25 is 5,070. March 26 affordable book is going to be 9,500 crores. And March 27 it's going to be 15,000 crores. March 27 emerging is going to be 25,000 crores. So 40% of the book in FY27 is going to be from emerging and affordable, and the balance 60,000 will be prime. Prime, we are by design, the growth rate, we have tapered it down because of margin reasons. Now, FY26, we have started one more new vertical called as loan against property, LAP vertical. Now, this also would help us on the margin. Corporate, this year we plan to disburse about 1,500 crores. So the segment shift, we are focusing more on affordable, more on emerging, prime. We're trying to taper it down. The growth will be obviously lower by design, restart of corporate, and a new vertical called LAP. All of these things will ensure that growth definitely would be there. I'm sure in next 2 years, the growth will be in excess of 20% given the mix. If you take only affordable, our growth is the highest. If you take emerging, our growth is the highest. FY25 emerging growth is 21% on book, and affordable is 183%, and prime is 12%, and this is by design.
Therefore, where should margins lie and where should yields go?
So margin would be stable. Whole of FY25, NIM was 3.7%.
Correct.
We will be able to maintain that for next 2-3 quarters, and then the margin will start inching up because of the mix change, because of restart of corporate, because of new vertical called LAP, which we started this year.
And any tailwind you will that the margin will get from the repo rate cut?
See, we are very clear on profitability. We are very clear on margins. So whenever there is a rate cut, we pass on the benefit to the customer. Once we saw that benefit coming into our cost of borrowing, so that we are going to pass it on. Apart from that, consciously on 5 things we are trying to increase margin. In prime, we are trying to increase our margin. In emerging, we are trying to increase our margin. In affordable, we are trying to increase our margin. Corporate will be a restart. It will come at a better yield and therefore better margins. And loan against property will come at a better margin. So these things would ensure that we would have enough levers to increase our yield and therefore better margins.
Got your point. And how much therefore would the normalized margin be at?
So FY27, our NIM should be in the range of 4.1 to 4.2 standalone. So today, for example, we are talking about ROA of 2.6, 2.7. So once this write-off pool is exhausted, our credit cost is going to be 25 bips. So FY24, FY27, FY25, FY26, the credit cost would be quite subdued. It will be neutral. It will be negative. So FY26 also credit cost will be negative, therefore aiding for better profitability. Come FY27 stand alone, our NIM is going to be 4.1 to 4.2. Our ROA is going to be 2.5 to 2.6.
Got it. And your credit cost will be sub 0.3 is what you mentioned.
Our credit cost will be 25 bips.
25 bips, yeah.
In FY27, standalone.
Correct. What gives you that confidence? Because you're lending now to corporate, loan against property, affordable housing, where you could see a bit of an inch up. You've not done that in the past, and therefore what gives you the confidence that you'll be able to maintain that kind of credit cost number?
So even if you look at a credit cost now, it's in that range, 0.2 to 0.22.
Sure.
If you look at FY25, so the way we are building book, we are very, very sure because now affordable book is sizable. It's more than 5,000 crores. Emerging book is sizable. So we've seen our credit cost panning out, which is in the range of about 20 to 22 bips now. So it will inch up and it will be around 25 bips standalone. Even today, if you take credit cost, it's hardly anything. Because of write back, it is negative. Otherwise, it is sub 25 bips. Come FY27, given the mix change, more skewed towards affordable, emerging, new vertical lab. So our credit cost is going to be 25 bips.
Yeah, that's exactly what my worry is. You're moving into these segments. My worry is not the 2.6% ROA if you do 25 bips of credit cost. I don't think that is worrying the street at all. Is there a downside risk to that credit cost number is the only worry. What gives you that confidence? Again, because you're doing all of these new businesses and hence, some bit of apprehension on this count.
All these are new businesses, to us in some way. For example, loan against property. It is not new business. We are doing loan against property for last over 30 years. It is only a focus by having a dedicated vertical. So it is not a new business. The only new business is going to be corporate, and there the plan is to take at a portfolio level to about 5 to 6% by FY27. That will be hardly anything. It will be about 5,000-6,000 crores. There we are very pick and choosy on developers, on the project selection, on the geography and stuff like that. So it's hardly any amount to be really worried about, because rest, whether it is prime, whether it is emerging, whether it is affordable, all the three book, if you see, it is quite substantial, and we have enough experience on that. And the new vertical, it's only new vertical, not a new business. Business is old, 30-year-old. It's a new vertical, just to bring in that extra focus so that the profitability betters.
Got it.
So because of that, we are very, very sure our credit cost is going to be around 25 bips, because this is something what we have seen for last 3 years.
Understood. Point taken, Girish. Thank you so much for this conversation, for being so candid and speaking with us today on KYC. But completely out of time on this edition of KYC. That's all, in fact, the time we have from myself. Everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30%.
Markets trade flat at midday in broader markets edged slightly higher. Nifty defense gains close to 4% as a top sectoral gainer. TVS Motors declines 2.5% on profit booking despite the company recording a strong set of Q4 earnings and brokerages giving a thumbs up. Tata Technologies tanks over 5% after 1.6 crore shares were sold in a block deal. TPG Rise is likely to have sold the stake for 676 rupees per share. Mark Carney-led Liberal Party emerges victorious in Canada's 2025 elections to form a minority government as the party fails to secure 172 seats. Conservative Party leader Pierre Poilievre says will continue to fight. Hello and welcome to Markets at 12. This is Malika Mishra. India and Pakistan have long been tied in what is viewed as one of the most bitter cross-border relationships between any two neighboring countries. And one primary subject of contention between these two neighbors since the time of partition has been Kashmir. And Pakistan has most often than not expressed claim over the disputed land of Jammu Kashmir via terrorist attacks. But with the recent Pahalgam attack killing 26 innocent lives, India has had it enough. The government, in its swift response, suspended the Indus Water Treaty in abeyance, ordered Pakistani nationals to leave the country, halted trade, and openly proclaimed punitive retaliation against those responsible. However, in the immediate aftermath of these intense altercations, Kashmir bears the brunt as safety concerns push people away, further isolating the region and impacting revenue from tourism. In fact, in a bid to tighten security, the Jammu and Kashmir government has closed more than half of the tourist destinations. To give us more information on the matter, let's go across to my colleague Naseer Masoodi from NDTV.
Well, while the major tourist destination will continue to remain open, which includes Pahalgam, but several important destinations have been closed. Last week, like 4 days back, there was a meeting of Chief Minister with the stakeholders, hoteliers, tourist operators. He was informed that some of the destinations were shut. He was taken by surprise. Then he inquired from the police and the Director Tourism. He was told this, it is a temporary measure. But now what we are hearing that 48 out of 87 destinations and the resorts have been closed as a preventive measure because of the security concerns after Pahalgam massacre. So this is a huge decision, and it means also huge impact on the livelihood of people who had invested, who were hoping to earn their livelihood. So this massacre of innocent terrorists has not only killed 26 people, it has also killed the livelihood of thousands of people. I'm here at Pahalgam, where I can show you a week after the massacre, what it has done to the bustling, otherwise a bustling township. So, this used to be a bustling township. Police had tough time a week ago to regulate the traffic, but today very few vehicles moving here in this town. Not every shop is even still open. The town is trying to come to terms with the loss and the tragedy here in Pahalgam. So this is the cost people have to pay, while the innocent 26 people were killed. Yesterday in Assembly, we saw there was every party and leader was on the same page, and then the Chief Minister made that very emotional speech talking about how innocents were killed because of their religion, because they were profiled. Children and women were separated. It was exactly the same way. We know there have been so many theories which we have done, but clearly it was an attack to target the tourism here, because tourism was seen as a symbol of peace and normalcy in Jammu and Kashmir. Now a major setback also because of this attack. Around 48 destinations and resorts have been closed for the tourists in Kashmir Valley.
And with that, while tensions escalate, cross-border terrorism intensifies and retaliatory rhetoric bitters, defense stocks have been rallying. And to explore the intersection of geopolitical developments, market dynamics, and the strategic role of defense companies, I'm being joined by Amit Anwani, research analyst at PL Capital, and my colleague Mihika will be partaking in this conversation as well. Thank you so much for giving us your time, Amit. My first question to you would be, the Nifty Defense Index jumped about 4.5% yesterday, marking its strongest intraday gain since mid of April. It in fact is one of the top sectoral gainers today as well. Now, do you see this rally as a short-term reaction to India-Pakistan tensions, or does it signal a longer-term bullish outlook for the defense sector?
Right. So I think answer in two parts. Definitely, there's a sentimental element which is going on because of the geopolitical tensions happening, and this could indicate for the defense companies that there could be future orders coming in, the faster deliveries for arms, ammunition, and the defense platforms, which is expected. And we are hearing this from past 1 week after the Pahalgam terror attack. So I think that is one element. Definitely sentiments are playing, but I have been talking about this that from the past 7-8 years at least, the government has been talking about creating a very strong defense ecosystem, localizing a lot of platforms, including so the import component has gone up from it used to be 45-50% for a lot of platforms, has gone down to 33%, 35%. So I think the focus is to localize, do a lot of technological collaboration and local Indian manufacturing. So that has happened. Second thing, if you talk about company to company, there's very strong momentum for defense electronics companies and also the aircraft and submarine companies, basis the kind of replacement the Indian Armed Forces and Air Forces has to do over the next 15 years. So coming to HAL, I think they have already built a very strong order book. I think they're structurally long term with respect to the deliveries which are scheduled for LCA, the two orders which they got, 83 aircraft and 97 aircraft. So I think if you see the long term growth for HAL can change because they already got 190 aircraft to be delivered. There are talks about a couple of more orders coming in for the fleet replacement. We want to replace almost more than 300 aircrafts over the next 15 years. So I think that way, directionally and regime-wise, things have changed for defense companies, and they are on the strong footing because of the government focus also in the past. Yeah. So I think this is one thing also we have been highlighting in past conversations, which is playing out in valuations as well.
Got it, Amit. I also want to, Amika joining here this side, I also want to focus on the key announcement that was made yesterday. I mean, the India-France Rafale deal of 63,000 crore, the pact signed. Now, part of this deal does include an offset clause that pushes domestic production of the Rafale jet parts. Do you see any beneficiaries from this order itself? Because now this is something where the order or the deal is expected to be completed by 2030. So there is a medium-term play here.
Right. So if you see in the past when these deals have happened, the government to government deals, so the few of the companies are not in my coverage, but just to highlight that who might get benefited, the Astra Microwave has got orders. I think Apollo Microsystem has got orders. So these are companies who won few offset orders in the past. Data Beton won some orders for electronic warfare for I think a few platforms, and then I think for BrahMos that they got few offset few years back. So I think this especially the defense electronics ecosystem. I would say the sub vendor based ecosystem is largely a beneficiary for any offset clauses and government to government deals happening. And we have seen few companies seeing numbers and profitability going 2x, 3x in the past, especially all this smaller defense, private defense electronics companies. So I think the offset clause will definitely benefit the private defense electronics companies, especially. So that is there. Apart from that, I think not directly to offset, but Bharat Electronics has been a beneficiary at large when all these large orders are coming, whether to the HAL or also to Mazagon Dock, because there's at least 5 to 15% defense electronics component in all these platforms, and the government narrated in their ambition for the current year that they want to focus on faster execution and faster clearances of orders, and that will be executed over the next 5 to 7 years. So I think Bharat Electronics is a diversified play across three services and have been winning orders constantly last year. So I think they are also beneficiaries at large when the defense ecosystem is developing and orders execution are fasting up.
Amit, you mentioned on how the order booking has picked up, but with so much uncertainty and geopolitical volatility in India itself, does that kind of, could it defer the long-term capital outlay or orders for something like the frigates, the 97 Tejas, the destroyers? Could they get deferred? I mean, we saw large ticket orders being expected even by something like a BEL last year, but this was deferred. So with different short-term requirements, could the long-term capital outlay, be delayed?
Right. So if you see, you rightly pointed with defense, there are few deferments and delays. But if you look at the longer ambition of the government, what they want to do, there have been orders raised to HL, right? So the order book was hardly 30-40,000 crore. Now they are sitting at 1,82,000, 2 lakh crore order. Bharat Electronics, I recollect, was 55,000 crore. Now they are almost 80,000 crore. And the deferment of order which you highlighted, I think QRSAM, which is one of the largest orders they wanted to win, and I think couple of more orders. But largely, I think there was some few months slippage, which I think is happening in few of the orders. But I would say this is much faster pace versus the last decade of 15 years and these 4-5 years and the future 2-3 years. I think the pace is much faster with respect to the order coming to the books of defense companies. And if you see across all the defense companies, there's a massive order book accumulation which has happened in past 3-4 years. And even government is trying for much more orders. So I think that way, if you see, they are on for 5 to 7 years of growth. If today we look at just 2 years forward, maybe we can see valuations looking a bit expensive for few counters. I think OEMs are trading at 35, 33x, and the defense companies, few of the electronics companies are trading at 40x and 35, 33x. But if you build in next 7-8 years of growth, I think they are in the very strong footing. Yeah.
Yeah, very well said, Amit. I think there's definitely a lesson there where you say that orders have become more rapid, they are healthy, and therefore they might be also projecting a strong growth in the future for many of the defense players. Now, my question to you is India spending enough to meet its defense goal? And could these recent developments in India-Pakistan diplomatic relations lead to an increase in the modernized defense budget? If I'm not wrong, it was about 1.5 lakh crore last. Do you think there could be an escalation in that figure?
Right. So see, our target has been, so as you said, I think 1,70,000 is the spending on capex, defense capex. And I think this should grow at least at 8 to 9% CAGR for next 5 to 6 years. And over next 5 to 6 years, government is targeting at least 9 to 10 lakh crores of domestic procurement for defense, including shipbuilding, aircraft, and missiles. So I think barring maybe 1 year, it could be 5%, second year, it could be 10%, but it looks that we'll be growing our defense budget for 7% for sure. There could be any year if the war happens or any situation arise that the budget might go up for next financial year on defense because things will be consumed while war. So that can happen, but I think for us, the long-term average is 7 to 8%. Now coming to where it is spent is more important, whether it is aircraft, helicopters, where the allocation is going to be higher. So past 2 years, the aircraft allocation was higher. We saw helicopter order coming in. We are trying to replace a lot of helicopters. So HAL is a major beneficiary. We saw orders getting cleared last month for helicopters also. For submarines, obviously, we are going to procure 3 additional submarines where MDL is a large beneficiary. They have delivered the 5 to 6 submarines already Scorpion series, and government wanted to add 3 more submarines, which could be as high as 25 to 30,000 crore plus order. So all this takes a lot of time to execute also, but definitely a bump up in revenues of these companies can come. So I think that is something which is where there could be a beneficiary. So I don't think that there could be 1 year where the growth will be better, but I think 7-8% is something we can expect as a defense capex growth for next 5 years.
Okay, so 7 to 8% growth in the next 5 years. Amit, we're short of time, but my last question to you is, if you had to pick top 3 picks from a medium to long-term specific at current levels, what would your picks be?
Right. So my coverage includes currently HAL and Bharat Electronics. Bharat Electronics is my top pick. We have a buy rating with 340 rupees. HAL, I believe, is a long-term story, though it is trading at 33, 35, but we are long-term very positive. There's a huge order book accumulation which has happened, and I think they can grow their top line at 12-13% CAGR and also bottom line with a similar pace. Now, the companies who are not under coverage could be beneficiaries. I have been highlighting the private defense, electronic defense companies, which few names I highlighted. All these companies can be a beneficiary for stronger spending in defense and also the offset clauses. So this is what can happen with defense spend.
Got it. Quite an attractive set of stocks, I must say. But Amit, I would just want to quickly understand from you, how well do you think is the private sector capitalizing on these geopolitical tensions as compared to the larger PSUs in the defense space in India?
Right. So I think there have been talk of fast tracking few programs, including LCA, where we are expecting, private sector participating. L&T already supplying some parts, and there is a talk that Tatas and all other companies should also participate. On vehicle side, combat vehicle side, already Bharat Forge, Ashok Leyland, these companies are working. On defense electronics side, Adani has entered, and there are few other small private companies who are doing a lot of R&D to get the defense electronics product ready for the future programs. So I think on an overall ecosystem basis, there's a lot to capitalize because government wants a lot of indigenous component in each of the platform, and at the same time, there's a hell lot of replacement fleet. So a lot of fleet in Air Force is aged. We are short of squadrons versus 41, 42 approved. We are at 32, 33 squadrons ready. So I think there's a massive opportunity. Only thing we need to build on technology or technology transfers or local indigenous manufacturing on defense. I think for private sector, it will be one of the good growth opportunity in future years. Yeah.
Okay. With that, Amit, I'm so sorry that I had to hurry you through this conversation, but we've lost time, and I would really appreciate all your views. Thank you so much for joining us and getting us that perspective into how defense is currently playing out. Most welcome. And Fino Payments viewers, the bank announced their quarterly numbers with a strong pipeline growth. To discuss more, we welcome Ketan Merchant, CFO at Fino Payments, and my colleague Harsh Saita joining in as well.
Well, thanks so much for that. Ketan, good afternoon. Good speaking with you. I want to first talk about growth, right? And and growth more so on the bottom line, because now you're starting to see bottom line growth along with taxes that you've been paying. So, so this post-tax number, how should it grow over the next 2 to 3 years? Just take us through what the journey could be. And I'm well aware you've applied for a banking license and therefore, or rather a small finance bank license, and therefore that may change. But broadly, given current business dynamic, how do you see that growth?
Well, Harsh, thanks. I'll just start off with the fact that this is a year where we've become a tax-paying company. From quarter 2 onwards. We started paying tax. So yes, it is indeed good to have the PAT coming across. As regards to a long-term plan which we have, you rightly articulated of currently we are growing in the range of 20-25, whilst we have not put official guidance around this, but in the past we've said that our sustainable growth would be in that range of 20-25. So we do not see any change happening across that. Our growth drivers, I think it is more important that how will that growth come through. So in my mind, there are 2 drivers which we are having in terms of growth. One is our ownership business and the CASA piece, which I just mentioned of, and the second one is our digital payments, which has been growing, which last year has actually grown by 4.2x times, and CASA has also grown by around 50%.
Okay, so both of those likely to keep your top line growing at around 22-23 odd %, which is what it's grown by at least in Q4, as well as largely what you've grown by in FY25. Is that how one should look at it?
In FY25, the whole year we've grown by around 25% plus, and sequentially YOY we've grown by 23%. Yes. Momentum is largely there. There definitely are some, headwinds which essentially come through in terms of the regulatory challenges on cyber, etc. But I think we have done some mitigation factors as well. So these 2 would be our growth drivers, which will, continue for, in terms of our ownership challenge until we get into a small finance bank license, as in when it comes from the regulator.
Talk a little bit about that. What's the timeline like for that?
Well, Harsh, it's very difficult to predict the timelines. I can just say what is happening and the status which is there. So we'd applied in, December 23, and thereafter the discussions with the regulators are on. My understanding is regulator has also formed a committee. We're not the only guys. There are other 4 or 5 entities which have applied for enhancement of their license or getting a banking license. So that is being worked throughout as well. I cannot put a timeline per se to this, but I can just say that there are conversations which are happening, and as we speak, the process is being followed in terms of a small finance bank license.
Okay, so Ketan, how should an investor look at you? You're currently roughly at 92-93 crores in terms of profit after tax for FY25. You're trading at roughly 2100 crore in terms of market cap. So you're roughly at 22 times, 23 times earnings. Is that the correct way to look at it? Is book value the correct way to look at it? And I'm not asking you to comment on the multiple. I'm just asking you to comment on how one should look at the business.
I think, Harsh, that's a very fair question. Let me just give some data and statistics, and maybe without naming any other peers. We have around 1700 crores of fee-based income. And that is where our USP lies. Whilst we are a bank, but majority of our income is coming from fee-based. And that is a transaction bank which we built across. Whether we go, as in when we go into a small finance bank as well, we intend to continue the impetus on fee-based income. That is the growth.
Lost Ketan for just a minute there. Maybe we'll try and patch him back. But surely not a bad set of numbers, because when you adjust for taxes, profit before tax has gone up in a decent fashion. Okay, Ketan, back to you.
Sorry. So what I was saying is that for us, small finance bank license will be addition of a credit line. It's not that suddenly a transaction bank, and which is our DNA and which is our USP. We do not grow that. So our growth will still come, or majority of growth is expected to come from our fee-based income as well. So I would reckon, without quoting a number, what should be the multiple price to earning, price to revenue should be the way we should be assessed on.
So then, Ketan, if you believe that a 25% growth rate is achievable on your top line, which should flow through the bottom line, why try to upgrade and go into lending?
Oh, that's a very, very, very pertinent question. Just to upgrade and go into lending does not essentially mean that we become a lending-oriented bank. There are some regulatory restrictions where we have for our payment bank. So I think evolution of license besides lending allows us to leeway on liabilities as well. Currently, there are limitations on liabilities for 2 lakhs. The rate at which we are growing, we open around 9,000 odd accounts on a daily basis. The kind of data monetization which we have, or opportunity of data monetization, all of that will help in terms of lending. I again repeat, we're not going to become a lending-oriented small finance bank. A lending or credit would be just an incremental product which will help us to grow our fee-based income as well. So that's how we need to have a like-to-like peer who is working on such a differentiated strategy currently. But we proved that in the past as well, that we can be differentiated.
And Ketan, what about this entire market with regard to cross-selling of loans? Are you at all tapping into that? Is that a large opportunity which you're looking at? Because in terms of geography, you've got a very wide reach.
Yeah, we have somewhere around 1.9 million merchant or network points through which we leverage all our products as well. Yes, we are indeed going into, currently by virtue of our regulation, we can only do referral of loan sourcing, which is what we are ramping up for the last couple of. And we intend to continue doing it this year as well. It also helps us to make the railroads, as in when our license evolves into, we'll have our processes right. Having said that, given the regulatory restriction which we have, is it very simple to have a loan referral product within the regulatory benchmark? It is not as simple, but we are actually making our processes right so that loan referral becomes the base for eventually loans which we may essentially give it to our own merchants or the people who are doing business with us.
Okay, thank you so much, Ketan, for coming in, giving us all of those insights and wishing you all the very best for FY26. Which will be the full year in which your PBT will see a tax impact. So it will be interesting to see how those numbers evolve. Yes. With that, back to you, Malika.
And with that, viewers, that's all the time we have on the show. But do stay tuned to NDTV Profit for more news and updates.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Apollo Tyres, now there's a buzz of a positive corporate development related to its European operations of European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
Hello and welcome. You're watching Profit Buzzers on NDTV Profit with me, Somit Sarkar, and my co-anchor Varsha. Well, Varsha, market continues to remain flat. In fact, Nifty IT is the top sectoral gainer in trade.
Yes, exactly. But let's pull out the contributors when it comes to Nifty 50. As you rightly said, the benchmark Nifty is trading flat. And let's see who are the contributors. On the loser side, you have Dr. Reddy's, you have Ultratech, you have iShares, Power Grid and Coal India, while on the gainers side you have BEL, RIL, Tech Mahindra, Eternal and L&T. Let's just pull up the sectorial heat map. Let's see what's happening there. Barring Nifty IT, everything is under pressure. Well, if you see Nifty Auto, it's down almost 0.3%. Nifty Bank is down 0.14%. Nifty IT on the other hand, if you see, is up almost 0.14%. Nifty Pharma, if you see, is down 0.8%. So barring Nifty IT, everything is in red. Let's just see what broader markets are doing. Let's pull out the chart when it comes to Nifty Midcap 150, though broader markets are actually in green, not mirroring a benchmark index. Let's see who are the gainers when it comes to Nifty Midcap 150. All the defense stocks, if you see, are up today. They are gaining now. This is on the back of India-France Rafale deal. India to procure 26 naval variants of Rafale fighter jets. You have Mazagon Dock, you have Cochin Shipyard, which are on the gainers list when it comes to Nifty Midcap 150. On the other hand, Tube Investment, Prestige Estates, Bharat Dynamics are also on the gaining list. When I talk about the losers, you have Tata Tech, you have Adani Wilmar, Oberoi Realty. Now, Oberoi Realty, if you see on the back of numbers, the stock is down almost 2%. Now, the highlighting factor when it comes to Oberoi Realty is lower pre-sales and slower collections that the company has seen. Aurobindo Pharma, if you see, again is down on the back of fire at one of its facility. Let's pull up Nifty Small Cap 250 as well. Let's see what that counter is doing there. It should be up. It should be in green. There you go. So 0.27% Nifty Small Cap. Let's see who are the gainers when it comes to Small Cap 250. Again, Garden Reach on the defense side. You have Whirlpool, Data Patterns, and Honasa Consumer gaining when it comes to Small Cap 250. While on the losers side, you have Sterlite, you have CSB Bank, Sterling and Wilson. Are on the loser side. So Somit, benchmark indices are flat, but broader markets are up.
Well, yes, let's also welcome in our guest Shamila Joshi, founder of shamilajoshi.com. Shamila, at this point of time, how are you looking into the markets, and what's your view overall when it comes to the benchmark and the Nifty Nifty 50?
Overall, I think we're doing quite well. We mustn't forget the fact that the kind of cuts that we saw about 2 or 3 weeks back on the when the first the tariffs were announced, I think that fear is sort of getting absorbed, and there is a growing sense that there could be rollbacks, and there could be so people are looking at May with a lot more optimism than when the news first broke out.